You are listening to The Vocal Technologist. Spoken tech for your ears.
You know, if you feel like the fintech sector is moving at a speed that makes your head spin, you are. You're absolutely not alone.
Oh, it's breakneck.
It is. This isn't just like incremental change anymore. It's a full-throttle technological revolution. We're talking about valuations jumping by billions in a single quarter. It's unprecedented. And since today is Founder Fridays, we thought we'd cut through all that acceleration to figure out who is really winning, how they're doing it, and what's fueling this whole thing.
Yeah, we really need to break this down for you. Because what we're seeing is that all this speed, it's really driven by three massive simultaneous shifts.
Okay.
You've got the Agentic AI revolution, which is turning AI from just a back office tool into the actual customer interface.
Yeah.
Then there's this huge infrastructure shift toward regulated tokenized deposits.
Right.
And maybe the most insightful part, we're seeing the most successful B2B players just completely diverge. They're not even competing anymore.
And to give you a sense of the sheer velocity we're talking about, let's just start with one number. Ramp, the spend management company. Its valuation just catapulted from $22.5 billion to $32 billion.
In 3 months.
In just 3 months.
Yeah.
I mean, that kind of acceleration tells you the winners are moving into totally new categories of finance, and they're doing it right now.
Okay, let's unpack that, starting with maybe the biggest catalyst, which is this AI takeover. It's no longer about these small, contained pilot programs. We're talking about giants putting hundreds of millions on the line.
Precisely. And the clearest example, the one that really stands out, has to be Intuit.
Right.
They just finalized a multi-year deal with OpenAI worth over $100 million. This isn't just a small integration. They are weaving their core products, so TurboTax, Credit Karma, QuickBooks, MailChimp, deep into the ChatGPT environment.
And that operational implication is fascinating, right? It means that you, as the customer, will be able to handle these really complex financial tasks with your permission, of course.
Of course. Things like estimating your tax refund, managing your invoices, checking credit options, even running small marketing tasks, all from inside the ChatGPT interface.
Yeah, it turns a chatbot into a financial command center.
Exactly.
It's a huge new distribution channel, but more importantly, it signals the arrival of what people are calling the agent economy. Intuit's already rolling out a whole new suite of 5 specialized AI agents for QuickBooks, starting with small businesses in the UK.
Okay, let's slow down on that for a second. What are these agents actually doing that a person used to have to handle?
Well, they're automating all those essential, repetitive, and honestly pretty tedious tasks that eat up an owner's time. So these agents are handling accounting, they're managing customer relationships, generating financial reports, setting up projects, and this is a big one, managing VAT analysis.
And just to be clear for everyone listening, VAT, value-added tax, that's a really complex consumption tax system in places like the UK. So automating that is a serious time saver.
It is. Intuit's own estimates suggest these agents can save a small business up to 12 hours a month. This kind of hands-off automation, this agentic AI, is why it's dominating all the industry trend reports for next year.
Okay, but hold on. If this is such a clear path forward, why is there this massive paradox lurking in the numbers? We've seen data that says a staggering 95% of AI pilots in big financial companies never see a positive ROI.
The ROI problem.
The ROI problem, exactly.
Right.
If banks are failing that often, why on earth are they still throwing $100 million at it?
That is the critical tension, right? It suggests that while the big banks are definitely running huge, complex AI workloads, the spending is undeniable, they're often just grafting new tech onto old, brittle operating systems.
So they're putting a Ferrari engine into a 1980s station wagon.
Exactly. They're trying to optimize legacy processes. On the other hand, the real innovation lead seems to be with companies like Ramp, Nubank, Mercado Libre, companies that are truly AI native.
Meaning they were built with AI at the core from day one.
Right. Their whole structure, their data architecture, their risk models, it was all designed around AI. They're inventing entirely new products, not just automating old ones.
And you can already see the direct consumer impact of that. I'm thinking of that story about the 67-year-old homebuyer.
Yeah, that's a great example.
She used the Homa AI platform to write and submit her real estate offer. And by doing that, she basically skipped the traditional agent model, closed faster, and saved almost $8,000 in commissions.
That's AI creating immediate, real-world financial value, not just some theoretical cost saving for a giant bank.
And that focus on speed and efficiency, it leads us right to the next huge shift.
Mm.
The institutional pivot to, well, a regulated digital dollar. It's not just about crypto anymore. Wall Street is going all in.
Yeah, the clearest signal here is JP Morgan. They have officially rolled out JPM Coin, their blockchain-based deposit token for institutional clients. This isn't a pilot program or a side project.
This is core infrastructure.
This is core financial infrastructure now.
So for anyone listening who maybe understands crypto but not institutional settlement, what exactly is JPM Coin? Why is this such a big deal for a bank like JP Morgan?
So JPM Coin is basically a tokenized deposit. Each token represents a real US dollar held directly at the bank. The critical difference is that it runs on a blockchain, specifically Coinbase's Base network, which allows for almost instant 247 money transfers.
Right, because the traditional system relies on business hours and carries all that risk that one party might default before a transfer finalizes.
Precisely. Tokenizing the deposit just vaporizes that settlement risk and instantly boosts the efficiency of asset transfers, repo agreements, cross-border payments, you name it. The fact that JP Morgan, Citi, PayPal, they're all moving this way shows that the operational advantages are just too big to ignore.
What's so interesting is that this huge institutional move is being mirrored almost perfectly on the consumer side. I mean, everyday payment apps are getting ready for this too.
Absolutely. Block's Cash App, which, millions of people use for P2P payments, is getting ready to support USDC transfers on the Solana blockchain. Now, that's slated for early 2026, but the direction is clear.
Stablecoins are moving out of the crypto exchanges and into your wallet.
Exactly. And the regulators are actually catching up, which is providing the confidence needed. The FDIC is already drafting guidance on how deposit insurance would apply to these new tokenized deposits. It's not a question of if anymore, it's a question of how.
And that confidence is trickling down. We're seeing a real cultural shift. I saw a poll that said nearly 1 in 5 Americans would rather get crypto than a traditional gift card for the holidays.
Which tells you people are starting to see these as practical tools, not just a speculative investment.
That cultural acceptance is the fuel.
Yeah.
Okay, let's pivot back to where we started with Ramp's incredible growth and talk about B2B FinTech. Because the very definition of winning has just fractured into like 3 completely separate things.
It's been a dramatic change. I mean, think back just 18 months ago to the whole SVB collapse.
Right.
Companies like Ramp, Brex, and Mercury were in this frantic land grab, all trying to absorb corporate deposits. They were seen as direct head-to-head rivals.
All fighting to be the one-stop finance shop for startups.
That whole model is now obsolete. Today, those 3 are diverging into what are, I think, accurately described as mutually exclusive business models. They're not competing over the same features anymore. They're exploring totally new territory.
Okay, this is the key insight we have to unpack. If they're not competitors, what are these 3 distinct paths?
Well, you can define them by their core focus. Ramp, having won the spend management and credit card space, is now leaning hard into software and automation. Their game is driving corporate efficiency, becoming the system of record for company spending. Brex, on the other hand, has moved way upstream. They're focused on treasury management and enterprise risk.
So bigger companies.
Much bigger companies that need sophisticated tools to manage liquidity, venture debt. They're more of a high-level financial partner now.
And Mercury.
Mercury has doubled down on being the banking infrastructure layer for the whole startup ecosystem. They've stuck to simple, integrated banking and API access, really cementing their role as the financial home for venture-backed companies. So you have efficiency software, enterprise treasury, and ecosystem banking. 3 totally different paths.
And that demand for high speed, very specific growth is what makes the underlying identity and risk infrastructure so critical. You can't afford fraud when you're moving that fast.
Trulioo is a perfect example of a company responding to this. They just introduced a new credit decisioning tool that layers real-time credit, financial, and risk data right into their identity platform. So those know your business or KYB checks can happen instantly and with much more confidence.
Which is a huge leg up if you need to onboard a new corporate client immediately.
Yeah.
What about stopping the actual bad actors?
They're using advanced AI for document verification, and they added this really clever feature they call known faces biometrics. It's designed to flag repeat fraudsters who try to open new accounts with different business details. And the early adopters are already reporting something like a 15% drop in repeat fraud. It lets the good guys in fast and slams the door on the fraud rings.
It's so interesting to contrast that high-stakes B2B battle with how the consumer giants see things. American Express, for example, is basically just shrugging off the massive growth of buy now, pay later.
That really highlights the power of owning a very specific demographic. The MX CFO was quite blunt about it. He basically said BNPL users tend to have lower incomes and credit scores than their core customers.
Right.
Amex targets affluent, high-spending consumers who pay big fees for rewards and perks.
So they're basically saying that's a different financial problem for a different customer, so they're not our competition. It's a great reminder that if you own a very specific high-margin niche, you can just ignore the fight happening in the low-margin mainstream. We focus a lot on the US, but this acceleration is happening everywhere. The speed we saw with Ramp, it's being mirrored by explosive growth and modernization all over the globe.
Absolutely. Just look at India. The payments company Pine Labs, which is backed by giants like PayPal and MasterCard, had this hugely successful $440 million IPO. The stock finished up 14% on day one.
That's a huge infusion of capital.
It is, and it drives massive regional expansion. Or look at Europe, where you have these new challengers moving with incredible speed. A Danish payments startup called FlatPay just hit a 1.5 billion euro valuation. They went from 7,000 to 60,000 customers in 18 months.
Wow.
They are aggressively going after giants like Adyen. It just shows that even in crowded markets, speed and focus still win.
And we're seeing these strategic partnerships become the key to modernizing, especially for established players. Wealthsimple, for instance, which just passed $100 billion in assets, they partnered with Wise.
Right.
Now they can offer fast, low-fee international payments to 30 countries right inside their app. It creates that unified experience people want.
Meanwhile, you see legacy players trying to rebuild their ecosystems from within. PayPal's relaunching in the UK as this unified payment experience, integrating online and in-store through their PayPal Plus reward system. It's all about creating stickier, more integrated platforms.
I think I've heard that discussed before on the Vocal Technologist platform, that sometimes integration is more important than pure innovation.
And none of the speed, not the IPOs, not the instant payments, not the AI agents, none of it is possible without modernizing the core infrastructure. It all comes back to the APIs.
So why do APIs make such a fundamental difference?
Because building new features like P2P transfers or QR codes or a new rewards program on those old legacy banking systems can take months, sometimes years. And today, if you can't deliver new features almost instantly, your customers will just switch.
They're gone.
They're gone. The core banking innovators are all saying the same thing. Legacy systems aren't just inefficient anymore, they are active growth bottlenecks. ATIs unlock that rapid modular deployment that enables everything else we've been talking about. So, to kind of synthesize this whole incredible moment in finance, we've really covered two defining shifts that you need to internalize. First is the full integration of Agentic AI. It's moving from those costly pilot projects with a 95% failure rate to becoming the core operating agent for how companies work.
Right.
And second is that massive simultaneous race to digitize the dollar itself, both at the institutional level with things like JPM Coin and at the consumer level through platforms like Cash App.
And it all comes back to that aggressive divergence we see in the B2B space. Yeah. We started with Ramp's insane acceleration, but we found that Ramp, Brex, and Mercury aren't even on the same racetrack anymore.
Not at all.
They've actively chosen three separate, mutually exclusive paths: efficiency software, enterprise treasury, and ecosystem banking.
Mm-hmm.
And that's the powerful, kind of provocative thought we want to leave you with as this all speeds up. If the best, most agile companies in corporate finance are already choosing to stop competing directly and are instead carving out entirely different quadrants of the market, what does that mean for our traditional idea of competition? Will any of these fintech giants even be recognizable as rivals in 18 months, or will they just occupy such vastly different domains that we won't even compare them anymore? That's the fascinating new reality you're now better equipped to analyze. We really appreciate you joining us.
Spoken Tech, for your ears.